Ever wondered how to invest in stocks wisely? Well, you're not alone. The world of stocks can seem like a complex maze to the uninitiated, but with a little knowledge and understanding, it can become a path to financial growth. Let's start with the basics. What are stocks? Simply put, stocks represent ownership in a company. When you buy a stock, you are buying a piece of that company, becoming a part owner or a shareholder. The more shares you own, the larger the portion of the company you own. Now, why would you want to own a piece of a company? The answer is simple: financial growth. Stocks have the potential to increase in value over time. If the company performs well, the value of your shares can go up. This increase in value is known as capital appreciation, and it's one of the ways investors can earn from stocks. But that's not all. Some companies also pay dividends to their shareholders. Dividends are a portion of the company's profits distributed to shareholders, usually on a regular basis. So as a shareholder, you can earn from the increase in the value of your stocks and also from dividends. Investing in stocks can be a powerful way to grow your wealth. However, it's important to remember that stocks should be a part of a diverse investment portfolio. This means spreading your investments across different types of assets to spread and manage risk. Stocks, bonds, real estate, and other investment vehicles each have their own potential for returns and risks. A diverse portfolio can help you balance these returns and risks and potentially lead to more stable financial growth. Now that you know what stocks are and their potential, it's time to dive into the process of investing in them. But remember, investing in stocks is not a get-rich-quick scheme. It takes patience, research, and a well-thought-out strategy. So stick around as we unravel the intricacies of stock investing one step at a time. Before you start investing, it's crucial to understand the basics. Let's take a moment to familiarize ourselves with some of the terms and concepts that form the foundation of the stock market. Firstly, what are shares? Well, when a company decides to raise capital, it does so by selling portions of itself to the public in the form of shares. If you buy a share, you're essentially buying a piece of that company. You become a shareholder, owning a fraction of the company's assets and earnings. Now let's talk about dividends. These are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Not all companies offer dividends, particularly those in growth phases. They may prefer to reinvest their profits back into the business, but well-established firms often do provide this benefit. Next up is the term stock exchange. This is essentially a marketplace where buyers and sellers come together to trade stocks. Some of the most well-known exchanges include the New York Stock Exchange and the Nasdaq. Now, let's delve into the concept of supply and demand in the stock market. The price of a stock is determined by the supply, the number of shares offered for sale, and the demand, the number of shares investors wish to buy. When more people want to buy a stock, demand, than sell it, supply, the price goes up. Conversely, if more people wanted to sell a stock than buy it, there would be a surplus of supply, and the price would fall. Remember, the stock market is not a one-size-fits-all scenario. Various factors influence the price of a stock, including the company's earnings, the state of the economy, and investor sentiment. Armed with these basic terms, you're one step closer to making your first investment. Understanding these foundational elements will give you the confidence to navigate the investing landscape with more ease and clarity. So stick around as we continue to unravel the mysteries of the stock market in the upcoming scenes. To invest wisely, one must never underestimate the power of research. As we journey through the world of stock investing, this is a mantra that we must take to heart. It's not simply about buying low and selling high, but understanding the intricate dynamics that drive the market. Imagine you're in a bookstore, perusing the shelves for a good read. You wouldn't just pick up the first book you see, would you? No, you'd probably check out the blurb, read a few pages, maybe even look up reviews online. Similarly, investing in a company's stock isn't something you do on a whim. It requires a level of knowledge and understanding that can only come from thorough research. One of the cornerstones of this research is reading financial statements. These documents are a company's report card, revealing its financial health and performance. They include the balance sheet, income statement, and cash flow statement. By looking at these, you can get a sense of how the company is doing, whether it's profitable, and how it manages its cash. But numbers aren't everything. It's also crucial to understand the company's business model. What does it do? How does it make money? Is it part of a growing industry? These are some of the questions you should be asking. The answers will give you a clearer picture of the company's future prospects. And let's not forget about keeping up with market news. The stock market isn't an isolated bubble. It's influenced by a multitude of factors, from economic trends and political developments to technological advances and societal changes. Staying informed about these can help you anticipate market movements and make more informed investment decisions. So before you dive headfirst into the world of stock investing, remember to arm yourself with knowledge. Look beyond the stock price. Dig deeper, read financial statements, understand the business model, stay updated with market news. Remember, knowledge is power. The more you know about a company, the better your investment decision will be. And this, my friends, is why research is key. Investing in stocks isn't just about picking winners, it's also about managing risks. Now, let's dive into the concept of diversification and its role in risk management. Imagine putting all your eggs in one basket. If the basket falls, all your eggs break. That's the danger of investing all your money in a single stock. If that company performs poorly, your entire investment is at risk. Diversification is like using multiple baskets. Even if one falls, the others can still be safe. Diversification involves spreading your investments across various sectors and stocks. It's like building a financial buffet. You wouldn't fill your plate with just one kind of food, right? Similarly, you shouldn't fill your portfolio with just one kind of stock. This way, if one sector is performing poorly, others might be doing well, offsetting potential losses. For instance, if you invest in technology, healthcare, consumer goods, and energy sectors, a downturn in technology won't wipe out your entire investment. The other sectors may still perform well and compensate for the losses in technology. Diversification is a risk management strategy. It doesn't eliminate risk completely, but it can significantly reduce the potential damage. By investing in a mix of assets, you're less likely to lose all your money if one investment fails. But remember, diversification is more than just owning different stocks. It's about owning stocks that behave differently under varying market conditions. For example, defensive stocks such as utilities and consumer staples might hold up well during downturns, while cyclical stocks like technology and consumer discretionary might soar during economic growth. In conclusion, diversification is like investing in an orchestra, not a solo performer. Each instrument plays a different part, but together they create a harmonious symphony. And just like a well-conducted orchestra, a well-diversified portfolio can weather the ups and downs of the market. Diversification doesn't guarantee profits, but it's a smart way to navigate the unpredictable nature of the stock market. Remember, investing is not a sprint, but a marathon. Diversification can help you stay in the race, even when the track gets tough. Stock investing isn't a get-rich-quick scheme. It requires patience and long-term thinking. This statement might not be what you want to hear, but it's a fundamental truth in the world of stock investing. You see, unlike a slot machine or a lottery ticket, the stock market isn't a game of chance where you can strike it rich overnight. It's a platform for building wealth gradually, over time. Imagine you're planting a tree. You don't just sow a seed and expect a fully grown tree the next day, right? You water it, you nurture it, and with time it grows. That's exactly how stock investing works. You invest in stocks, you nurture your portfolio, and over time it grows. Now let's talk about the magic of compounding, the secret ingredient of successful investing. Compounding is like a snowball rolling down a hill. It starts small, but as it rolls down, it collects more snow and grows larger. Similarly, when you invest in stocks, your initial investment might be small, but as you reinvest your earnings, your wealth grows exponentially over time. Think about it this way. If you invest $100 and earn a 10% return, you'll have $110 at the end of the year. If you reinvest that, the next year, you'll earn interest not just on your initial $100, but also on the $10 you earned. This is the power of compounding. It's not about making quick bucks, but about growing your wealth steadily and surely. So, when you invest in stocks, don't get swayed by short-term market fluctuations. Don't panic when your stocks dip a little, or get overly excited when they spike. Instead, stay patient, stay focused, and think long-term. Remember, the stock market is a device to transfer money from the impatient to the patient, so invest wisely and think long-term. Investing isn't about timing the market, it's about time in the market. So buckle up, be patient, and let your wealth grow over time.